Hi, my name is Mason Ballard, Coldwell Banker, and I'm going to do my best to explain to you how you can save money on your federal income taxes by buying a house. You write off the interest on the loan. So go ahead and let's get started. For example, let's say you make 45 grand a year. It's pretty good dough. That's a nice scratch. And right now, making 45 grand a year, that puts you in the 25% tax bracket, and you would pay $11,250 a year in federal income tax. Now, bear in mind, I'm not a CPA, and I don't pretend to be one or play one on TV. I'm just a real estate agent for about 7 years and a homeowner for 9. So I'm just telling you what I know, but I am not a CPA. Anyhow, let's say you go out and buy a house, and your home loan is 250 grand. At 5% interest on a 30-year fixed, your monthly payment would be $1,342 a month. That's pretty good. $1,300 a month that you're paying to live in that house with a $250,000 loan. Interest rates may vary. Okay, well, the first couple of years, the majority of that $1,300 is going to go towards your interest. And you're going to pay somewhere around $14,000 a year in interest on that loan. And that's going to change over time, but the first few years you have a 30-year fixed, the bank wants to get their money before you get yours. So they're going to charge you interest on the front side of the loan, and then you're going to pay the principal on the back side of the loan. Usually past about year 15, year 10, year 20, you start seeing some real big cuts in the principal you owe. But in the beginning, you're paying primarily interest, so you can write most of all of it off. Okay. Well, now, the good thing about that is that $14,000 that you paid to live in that house over the last year in interest, that's tax deductible. And you used to make 45 grand a year in the federal government's eyes and mind. Now your taxable income is $30,000. That's a big change. 45 before, 30 now. Taxable income. You're still making the 45, but your taxable, what you put on your tax information come April, $30,000. That's what you made. Well, now, this is the great part. Since you're in the $30,000 tax range, and this is saying that you file as a single person, no family, no kids, just single person. You know, it changes, cases may vary. You're now in the 15% tax bracket. So you went from being, where is it? It's around here somewhere. You went from being in the 25% tax bracket, where you're paying $11,000 a year in tax, to the 15% tax bracket because you wrote off all that interest. And now you're paying $4,514 in tax. You see where I'm going with this? That is, wait for it, a savings of $6,700. Woohoo! That's good money, you know? $6,736 is what you saved on tax. That's how much you would have paid in tax that year. So what can you do with that six grand? Well, you can take your buddy Mason out to dinner, or you can put it in your pocket. And on a monthly basis, that is a savings of $561 per month in taxes. And what I advise some of my clients to do is at that time, you can go ahead and change your exemptions, have them take less money out of your check because you're going to have to owe less money at the end of the year. Like they can take a $561 less out of the check because now you have this nice deduction for buying a house. Anyhow, this was Mason Ballard, Coldwell Banker. Thanks for tuning in. I hope you found this helpful. Take care.